Hello and welcome to the last episode of Africa Business Weekly for the month of July, as we bring you highlights of the biggest conversations that shaped the business landscape across sub-Saharan Africa. I'm Akin Obake. Now, from West Africa, we stay with fluid developments in Niger since the military takeover this week. From our East African desk, we have an exclusive with Kenya's Finance Minister, Professor Njuguna Ndungu, reiterating the country's economy is not at risk of a debt overhang. But it's now time to bring you the details of all these and more as we begin with our first crossing to Palesa for regional updates from Southern Africa.
We're back with more stories driving Southern African continent this week. We begin with a conversation CNBC Africa's Godfrey Mutizwa had with the president of Botswana, Mokgweetsi Masisi, about how the African Continental Free Trade Area should change how the continent does business with the rest of the world. Here's a look at that conversation for more.
The African Continental Free Trade Agreement is in place. Africa is in business. And in business, Africa doesn't want to participate as it traditionally was known to participate by generating raw materials and exporting them raw. Africa does not want to do business like it was known to do by exporting out of Africa more than it exported among the countries in Africa. Africa does not want to be known for poor standards of services and goods. We're in the business of value adding. We're in the business of intra-Africa trade. And Botswana is a keen player at that. Come here, invest here, and you have Africa as your oyster.
How has that message been received, Your Excellency? I'm asking the question because we know traditionally when we have raised this as Africans, we've been told that we are letting the state get in the way of the private sector. We should be driving these national strategies.
I think the message has been received excellently. The excellence that I expect you will have seen from the sheer number of attendees. We had more than 1,300. And we in Botswana strategically decided to rivet it and expand that number by broadcasting live to a number of locations throughout the country and engaging in conversations at the local level so that people at the household, local economy level could link up to this summit and to the rest of the world and Africa.
What do you want to see come out of this summit? Today is the last day.
What I want to see coming out of the summit are deals. What I want to see coming out of the summit are engagements, commitment to go and do work together. What I want to see coming out of the summit is a commitment, particularly by our financial institutions, to finance this ideal, because you cannot do anything without financing it. I want to see a riveting, a change, a moving of the dial as a result of this summit. And we had, in my view, a record number of heads of state who came, and they themselves engaged with some entities in the private sector, and they engaged among themselves, among each other. We did talk, and we were one on this.
Yeah, and from what you are getting in terms of the work that's been done here, what messages are you getting in terms of the things that you want to see done?
I'm getting a lot of commitment and excitement. There are many companies that have said, look, this summit has really resulted in making real warm felt connections. And it's a lot of work to be done following the summit, because you don't come out of the summit and have purchase orders.
Yes.
You come out of the summit and you have a commitment to take the discussion further,
right,
to suss out one another and then really get the deal going.
Next up, we spoke to Akim Aslam, the International Monetary Fund Mission Chief for Lesotho, to unpack the findings of their recent Article 4 consultations in the country and also go over economic prospects. Let's listen in.
Sir, this particular Article 4 consultation, the latest report for which you can actually find online on the IMF website, essentially we are emphasizing some messages that we've shared in the past, specifically relating to the need for fiscal consolidation, particularly on the expenditure side, with a view to undertaking certain growth-friendly consolidation measures in order to ensure that the government is able to switch from, or rather the country, is able to switch from a slightly more public sector centric framework to one where the private sector is given the chance to breathe. What we've noted in our report in particular, just to give you a little bit of background, is that Lesotho's fiscus is very much characterized by certain large and volatile external transfers from the Southern African Customs Union and high public expenditure, around 50% of GDP. And this has fostered a sort of boom-bust cycle where government financing has been marked by growing domestic arrears and also periodic gaps in that financing. And what's also worth noting is that the economy has unfortunately stagnated despite this high public expenditure. Since 2016, real activity and per capita incomes have shrunk by around 10%, and average growth in the decade preceding the pandemic was amongst the weakest in the Southern African region in particular. And even though Lesotho records a high capital stock as a share of GDP, this quality unfortunately lags that of its regional peers.
Yeah, so let's start with the fiscal consolidation with particular focus on expenditure. Which areas should the government be spending less in?
Absolutely. So I want to also emphasize the growth-friendly nature of these recommendations, and they've been constructed very much with that view in mind. Because the ultimate reality is, as we mentioned in the latest report, is that without this expenditure consolidation in particular, debt sustainability is at risk and foreign exchange reserves could decline over the medium term. Now, the specific recommendations, the areas that we're focusing on, are to lower the public sector wage bill, and this requires a review of the size of the civil service and also establishing clear targets for employment and wage growth. As I mentioned, sort of this consolidation is integral as this is one of the largest components of public expenditure for Lesotho. And what I'm happy to note is that the government has already started in these efforts to take some action to streamline the civil service and promote transparent recruitment. And it is absolutely vital for them to continue in this vein. Another important area is on public investment, which needs to really finance those areas that can maximize climate resilient growth and crowd in the private sector investment. And to do this, we have recommended identifying and minimizing those unproductive capital projects, improving accountability, project appraisal, contract design, ultimately so that the government can really invest and target the high value-added growth-friendly investment, which is also in line with their development priorities. And a third area in spending that we're obviously emphasizing is in social spending. There are a number of programs in operation in the country, but some of these programs need to be rationalized and also reprioritized to ensure that they target the most vulnerable and that they're dispersed in a timely manner. And finally, really, the fourth element, which underpins this expenditure containment, is some very vital and urgent reform on public financial management. These are the processes underlying the expenditure itself. And by this, we mean that it's important to ensure that processes are in place for a well-coordinated and transparent budget with robust and solid expenditure and procurement controls, as well as supported with sound treasury operations and fiscal oversight.
And that's all from my side. It's back to you.
Thanks for the update there, Palesa. Up next, we have Fiona on standby for more content from East Africa.
Thanks, Akin. Kenya's debt situation is within the country's debt carrying capacity, and there is no cause for alarm. The country's finance minister told CNBC Africa that the President William Ruto's administration was keen on cutting down on expensive debt as the country moves towards a sustainable debt policy range. Here is more from the minister, Professor Njuguna.
We wanted to argue, and we argue from a very, very policy-oriented policy level, is 55%. So that there is a signaling. When we are beyond 55%, it tells us we are going beyond the debt carrying capacity. What we want to show is that we have a policy range. For example, if the matter is now with the Senate, but if the Senate says that this is your policy range, we'll be acting on that range so that whoever looks at us, he knows that whether Kenya is beyond its debt carrying capacity or not. Right now, there's no way you can determine that. So when you say that Kenya has, some years back, I remember I started that work for Africa in 1989, and we published some work in 2021. It is on growing with debt in African economies, and we argue that the most important thing is to lower your debt so that FDI, foreign direct investment, or any potential investors do not refuse to come to Kenya because they are not so sure about your debt carrying capacity. Now we want to have a situation where you can analyze the information that you see. The debt carrying capacity in Kenya is 55%. Let's assume you are at 50%, at 62% as you mentioned. The signal is that from now on we are reducing our debt carrying capacity so that we do not create risk for potential investors. What is the risk? It is called debt overhang. That a potential investor will look at your debt carrying capacity, that is, you're beyond your debt carrying capacity, and they refuse to invest, or they explore, or they acquire what we call waiting option, because they believe that the government may raise future taxes to pay for the debt. Now, what we have done is to say, at 62%, we will start reducing our present value of debt towards 55%. How do we do that? We want to employ a very effective liability management. So we reduce that. Okay? So that is where we are. And you can see this will make changes. This will make this will become clearer. We have just done 8 months, isn't it? It will become clearer by the time we are perhaps in the middle of this new fiscal year, because that's where our strategies start working very well. We will reduce that so that the perception of risk, country risk, is reduced. Now, just like we have inflation, we have inflation is 5%, but we have a policy range. It revolves around 5% on either side, isn't it? So when you come in and you find that right now the inflation is about 7.9, everybody is saying, how is the central bank doing? The central bank is actually tightening monetary policy so that you move towards 5% or 7.5% range. If it is below 2.5%, then you say the government must be increasing the flexibility of monetary policy or lowering the tightening so that they can move towards the 2.5%. That's the whole idea. So that we have a debt policy range. The debt anchor provides you a policy range on either side. It could be defined strictly, or it needs only, like the National Assembly just said, look, it will be 5% plus 5%, and that's the policy range, so that the whole work is to make sure that you don't increase the debt to a particular level. Let me go back a little. The 10 trillion, what does it relate to? What would it relate? Can you relate it to an economic aggregate? Policy making is about relating whatever you do with economic activity. And the only available economic activity we use is GDP. So that's why we're moving back into a policy regime that is understood, with clarity, and also predictable. That is how policy making is all about.
The macroeconomic environment in the Democratic Republic of Congo has remained resilient, and as a result, the country has attracted major investment in all areas of the economy. One major player in this market is Equity Group, which acquired Banque Commerciale du Congo. We spoke to Celestine Mukeba, the managing director of Equity BCDC, who says the entity has seen significant growth in the markets.
Profitable last year with a profit before tax of $68 million, coming from the last year of $44 million. So we have seen quite significant growth as well in terms of our profitability. And this year, we are actually nearly at the same level of the entire profitability we have reached. So there is a good trend on our growth in all aspects. So in addition, since we are launching as well digital solutions in the markets, so basically with our bricks and mortar branches, which is supported by a huge expansion of agency banking. We are reaching close to 20,000 network across the country. So we are really ready to play our significant role in the economy. Let me just maybe say that we are building a very inclusive banking model in the DRC, which comprise um, corporate, SME, and retail banking. So basically, we intervene in all chain in the economy to make sure that we really capture the maximum of the opportunity, and we really bring solutions to our clients, be it corporate or the network around corporate constituted by the medium size company, small, medium, and companies, or looking at the retail with our different solution that we are issuing in the market.
So let's say I want to ask you. I'll ask you more about that, but I wanted to also ask you when you look at that growth. You just mentioned that you had a profit before tax of $16 million last year, and one would think last year was sort of a hard year for many sectors, given that countries were still dealing with the pandemic, but also the rising inflation. At the same time, in DRC, you were experiencing some of the geopolitical issues, such as the war in the eastern DRC. But my question is about the implication of monetary policy tightening on interest rates in DRC. What has been that implication?
Actually, we have experienced quite some strong GDP growth. The economy is very stable. Macroeconomic aggregate are very strong. Last year, the GDP stood at 8.9% GDP growth. That is one of the robust growth in Africa and even worldwide in terms of GDP growth. We have seen in the last 2 years the reserve of the central bank have increased significantly. It was below 1 billion. Currently, it's far above $4 billion and reaching close to 5 billion. So that's cover more weeks of imports. And inflation have been jugulated. Of course, end of the last year, the inflation have reached close to 15%.
That's all from me now. It's back to you.
Thanks, Fiona. It's time to bring you highlights from West Africa as we stay with developments from Niger, as world leaders condemn the military takeover, describing such as undermining democratic principles in the West African region and a threat to political stability, peace, and security in the West African region. Mutala Toure, senior geopolitical analyst for West and Central Africa, shared some insights into how Africa can break the cycle of coups.
On Wednesday, it's now almost the seventh military coup in both West and Central Africa, which highlights the high level of political instability within that region. Niger is a coup-prone country, so there was an assessment that the military coup in neighboring Mali as well as Burkina Faso could have a knock-on effect on Niger, but no one was thinking that it will happen this soon. And the president that has been ousted, President Bazoum, even when he won the election in 2021 March, just 2 days before his inauguration, there was an attempted coup against him, but that was foiled. And now we see that he has been ousted, and the military, they are given the same reason that the other military regime in Mali and Burkina Faso gave. They say that the insecurity in the country because of Islamist militant armed group in the north and south of the country, as well as bad governance and corruption. That's why they took over the government.
Now, we've had quite a swift level of condemnation in terms of what's happening now. We've had the World Bank, ECOWAS Commission, the AU weighing in heavy. And now ECOWAS has also deployed Beninese President Patrice Talon to Niger. Meanwhile, the soldiers here are saying they don't want any form of foreign intervention. How much of a penetration or pressure do you think external bodies can weigh in now to address this current situation? Is there any chance of taking back power, moving into democratic principles?
Looking at what happened in Burkina Faso, in Mali, as well as in Guinea, I don't think international pressure would force these coup leaders in Niger to hand over peacefully, because they can point to Niger. They can point to neighboring Burkina Faso and Mali, as well as Guinea, that the military, they are still there. They are trying to right the wrongs of their country. They're going to say this is a domestic and internal affairs. I think what we will see, according to the playbook of ECOWAS, as well as the African Union, they are going to suspend their membership within this international body, and then we're going to see diplomatic effort, because currently ECOWAS has decided to send the president of Benin, Patrice Talon, to go and talk to these coup leaders so that they can hand over, easily. But I think that's a tall order because of what we've seen currently in these three countries. But we think that has given some kind of incentive and motive for some of these military leaders to hang on. And now they have a club, because even if the rest of the ECOWAS democratic countries decided to sideline them, they can still count on the military in Mali, the military in Burkina Faso, and the military in Guinea.
And that brings me to my next question now. In terms of insights now, your publication in terms of Jane's Intelligence Review, what are some of the likely trends we'll see here? And for the fact that this scramble for Africa will continue based on this sort of scenarios panning out at this point in time. So what sort of inferences can we make at this point in time from Jane's Intelligence Review and what we might likely expect in the coming days?
Yes, so this is a really unfortunate situation. We now see the return of a military rule back into West Africa, and this is going to undo the almost 2 decades of ECOWAS effort to create some disincentive for this military personnel to use military coup, use the gun to gain power. The last time we see a military coup leader in power for more than a year, this was, it was.
Moving on now to the latest developments in Nigeria. Nigeria's Monetary Policy Committee members, let me take that, that was a bit rusty. Moving on now, Nigeria's Monetary Policy Committee members voted unanimously to raise the key interest rate by 25 basis points to 18.75%, narrowing the asymmetric corridor around the MPR to plus 100 minus 300, from plus 100 to minus 700 basis points, while leaving other parameters unchanged. Bismarck Rwane, CEO of Financial Derivatives, shared some insight into the impact of this move. Take a listen.
Analysis, it was no drama about it, but he did talk about the real interest rates, real effective interest rates, which means that he has his eyes on inflation and he has his eyes also on effective interest rates. How that will play out is something that we have to wait and see, but definitely the fact that he has that in his vision, in his horizon, means that he's going to do, or they are going to do, the right thing. I think there's no question about it. Right. And I've noticed de-emphasizing the unorthodox monetary policy. In the past, you'll hear about we've given 1 million users of anchor borrow. So I think just de-emphasizing that meant that he realized that those were negative, in the sense that it put money, excess liquidity in the system, and actually address the exchange rate. He also did say that there's going to be intervention around the comfort zone. All right. So I think that also tells me that there's a project, what I would say, there's a vision about what the exchange rate should be, and there's a process for keeping the exchange rate at that level. There's also a complete focus on inflation. So if you had those two, and then you have the interest rates adjustment, which is inevitable, then we are likely to be going towards equilibrium. And he did allude to the fact that he realized it lags. A lot of people think that it's an instant reaction. No. But I think, in all fairness, we are going to see interest rates increase in the money market. We are going to see effective lending rates increase. We are going to see a de-emphasizing of the unorthodox policies, right? And I think there will be a slow build back of confidence. Very slow build back. Right. Nothing instantaneous.
As far as I'm concerned, nothing has really changed. You have 5 people who voted to keep rates unchanged. I mean, in context, 25 basis points on 18.5. I mean, that's equivalent to like an 8 or 9 basis points move by the major European ECB, Bank of England, or Fed. If you're at the 5% level and you're moving 25 basis points, at the 18.5 level, 25 basis points is a rounding error. It's significant. But it's a signal. In terms of the asymmetric, what most people might not know is that banks have a cap on how much you can place in the central bank at the MPR plus 3 now. I think it's capped at 7.5 billion.
You mean minus 3?
Very material. Yeah, minus 3, sorry. So that 14.75, you can only place about 7.5 billion or so at that level. Now, unless the plan is to remove that cap and allow banks to place as much as they want in the central bank at that rate. Now, if that is done, automatically, it doesn't make any sense to buy any treasury bill at 6%. You just take your money to the central bank and dump it there at 14. Again, let's see what they do. But the reality is that most things that can be done now are purely administrative. There are lots of circulars that keep coming out, on how they will deal with some of these things. MPR doesn't do anything at all to market rates. It impacts bank borrowing. But I think what the message I heard underneath the hood is that there's going to be more administrative steps taken to deal with liquidity. And it's not really one of these variables that they mentioned today.
All right. Let's go to Femi now. Femi, your big takeaways from the first showing of Acting Governor Shonubi, it did appear very measured in everything he said. What big takeaway for me was that he acknowledged the pent-up demand and its impact.
And on that note, it's a wrap on this week's episode and the last episode for this month. Many thanks to Palesa and Fiona for the regional update. Do catch us same time next week for more exciting conversations. I'm Akin Bakeye. Enjoy your weekend.